Started. So welcome to another edition of Maryland Construction Network's Accounting Resource Group. For those of you who don't know me, I'm Kristen Bailey, the group's liaison. I'm a CPA and certified construction industry financial professional with Katz-Abash, a CPA and consulting firm that specializes in construction contractors. Here with me today, we have special guest speaker, Claudia Walter. She is a shareholder. She's a shareholder at Katz-Abash. She's also a CPA and a certified construction industry financial professional, and she's a leading shareholder in our accounting and auditing group. Also on the line, we have Sarah Lands, our director of marketing. She will be monitoring the chat, so if you have any questions, you can put them in there, and she will make sure they get to us. Okay, so today we're talking about the changes to the leasing standard. All right, so there's going to be some really large changes coming out in 2022 to financial statements. But first, let's start sort of at the beginning. So if you're a contractor and you're working with a CPA to prepare financial statements for a bonding agent or a bank, you're using most likely a framework called Generally Accepted Accounting Principles to prepare these financial statements. And these are sort of the rules that you follow to create your financial statements. And one of the main goals of this framework is comparability across companies. So if a bonding agent is looking at a whole bunch of contractor statements, he knows that they all follow the same rules to prepare the statements. An example of one of those rules is that long-term contracts are reported on percentage of completion. So he knows that if they're all prepared using this framework, all of their long-term contracts are on percentage of completion. So another one of those rules relates to leasing. And currently, under the current framework, there's two types of leases. We have a capital lease, and that's where you would lease an excavator, and you put the excavator on your balance sheet, and you put the liability on your balance sheet. Then there's an operating lease, and this is for copiers, office space. Currently, nothing goes on your balance sheet. You just expense those as incurred. But that is one of the biggest things that's changing. So under the new rules in this framework, we're going to have what's called a financing lease and an operating lease. The financing lease is replacing the capital lease, and it's very similar. You're going to have an asset and a liability. Now, with your operating leases, you will also have an asset and a liability on your balance sheet, and that's a really big change. The reasons behind this change is there wasn't enough visibility for the user related to this off-balance sheet debt. For the SEC registrants, there's $1.25 trillion of off-balance sheet debt, and there just wasn't enough information for the user to make relevant financial decisions. Also, we're trying to align with international standards, and they also follow this model of putting your operating leases on your balance sheet. It is effective for year ends in 2022. If you have to do some interim financial reporting in 2022, you do not have to follow these new rules. And you can also early adopt it if you would like. So in our new framework, we have this right to use model. So if you're a lessee, you are making monthly payments to your lessor, and for that, you're getting the right to use something. So in our old capital lease, you would be getting the right to use an excavator, right? You have an excavator in your fixed asset section of your balance sheet. Now you have an intangible called right to use asset, but your liability still is a leasing liability. And for your operating leases, before they weren't even on your balance sheet at all. Now you'll have right to use, office space, right to use copier, and a lease liability. So short-term leases are going to be exempt from this. And a short-term lease is 12 months or less. We know that contractors frequently lease their office space from related parties. And so when you have a related party lease, we're still waiting on guidance around this, but you might need to look at some of the underlying facts and circumstances. So if you have a month-to-month lease with your related party, but you did a ton of leasehold improvements and you guarantee the mortgage, it might look like a short-term lease, but the intent there, I think, is obviously long-term. So we're still waiting on guidance as to how these short-term leases with related parties will be treated. Lessor accounting also is not affected by this change. Right, so this change is very large and it's going to be hitting all parts of the financial statements. So on the balance sheet, again, we are going to be having a right to use asset and a liability. It's important to note that if you have that financing lease, that you no longer have a fixed asset excavator. You have an intangible right to use excavator. And on the income statement then, instead of having depreciation, you'll have amortization. The operating lease, again, goes on the balance sheet as right to use asset and will have a lease expense. There's going to be an increased amount of disclosures related to these leases. And on the transition, you're using the modified retrospective approach, which means you calculate everything, you calculate all of your assets and liabilities as of 1/1/22 and you book it 1/1/22. So here's just a quick overview of how each type of lease affects the major financial statements. So for operating, again, this is the biggest change. We have an asset and a liability, where before we just expense the payments as they were incurred. Now on the income statement, you're still going to have this single straight line lease expense. So your income statement is pretty close to what it would have been before. And your cash flow statement stays the same, where that cash paid is an operating item. Financing, this is the new capital lease. Again, instead of having a fixed asset, you're going to have an intangible and you'll have your related lease liability. We're going to have amortization expense instead of depreciation and the interest expense. And then cash statement of cash flow does stay the same. The principal portion will go in the financing and your interest will go in operating. So one of the things that we are recommending is for contractors to start reviewing their lease terms, their leases, making sure you have a good, making sure you're capturing all of them. And these are just a couple of things that you want to look at for when you're reviewing your leases. All right, now Claudia is going to walk us through how you determine if you have an operating lease or a financing lease, and then a couple of examples.
Sorry about that, I don't mute myself. What we need to do is look at these 5 criteria, and if any of these, the 5 conditions are true, then you have a financing lease. So some of these are similar to the old criteria that we look at to determine capital leases, but there are some differences. So first of all, does ownership transfer at the end of the lease? So we used to look, for bargain purchase options, that $1, or anything that would basically, incentivize the lessee to actually take possession of that asset at the end of the lease. The second one is the option to purchase is reasonably certain. So transfer of ownership is just, does it transfer at the end? The option to purchase is actually what I just described. So the option to purchase is reasonably certain. So that's that bargain purchase option or anything that would incentivize us to purchase at the end. The lease term is a major part of the economic life. That was the old 75% rule. So if you have an asset that's a 10-year, that would have a 10-year life and you're leasing it for 8 years, that was, 80%. So under the old capital lease rules, it was more than 75%. They've actually gotten rid of those bright lines. And now, it's blurred. They're just saying major part. So you have to determine what a major part is. So there's some subjectivity added there. The present value of the lease payments is substantially all of the fair value. This was the old 90% test. So if you present value your lease payment stream and it's greater than substantially all of the cost of the asset, if you were to just purchase it outright, then that's also considered a financing type lease. And the new one that they've added is the specialized nature of the asset. So if you are leasing an asset, it's going to have absolutely no alternative use for you at the end of the lease term, then that's considered a financing lease as well. So you really have to, in the construction industry, you'd have to look through, like, are you doing some type of, project where you're building a building and you have to have some asset manufactured that you're leasing in order to do some type of installation, and it's going to have absolutely no alternative use to you at the end. That's something that would then be considered specialized in nature and would be a financing lease at that point. Okay, so we're going to go through an example here. So the facts of this one are lease term is 3 years and there's no renewal options. The economic life of this asset is 5 years. There's no purchase option. The rent payments are $100 starting with a 3% escalation annually. The interest rate is 7%. And the interest rate is one of those things that's a little fuzzy. That's your incremental borrowing rate is what you're supposed to use. So if you were looking at a building, like a long-term type of asset, it might be a lower rate than if you are leasing a piece of equipment. So a short-term rate is typically higher than a long-term rate. So we're using 7% in this example. If the company was to go out and to just purchase the asset, possibly it'd be 7% rate. And then the fair value of this asset is $500. So first we're going to look at how we would calculate the asset value. So basically you run an amortization table of this asset. So for simplicity, we're saying there's one payment a year, it's $100, 103 for year 2 and 106 for year 3 at that 3% escalation. So when you present value that back, the row 1 there, which is the loan, which is the actual lease of the asset, the present value of that future stream of payments is $269. And then below that, you'll see the amortization schedule, what the balance is at the end of each year and what the interest is. And we're going to refer back to this a couple times. So just, you'll get a copy of the slides. You can look at this. Some of this is a little odd, but I just want to make sure that this slide's kind of important in the whole calculation. You can go ahead and advance, Chrissy. So let's go through the criteria and see if this is a financing or an operating lease. So does ownership transfer? No, it does not. Is the option to purchase reasonably certain? No bargain purchase option or anything like that. The lease term is a major part of the economic life. No, we're only utilizing it for 60% of its economic life. 3-year lease, 5-year economic life. The present value of the lease payments is substantially all of the fair value. No, because we calculated the present value of the lease payments at $269, and that's 54% of the fair value of the asset. Is the nature specialized? Again, no, this is just typical asset. So you can go ahead and, so we were going to say this is an operating lease under this example. So this is where it gets interesting and a little weird, I think. But so we know that the initial recognition of the entry, so in the bottom left of that slide, we're going to debit the right of use asset of $269. Thank you, Chrissy. And credit the lease liability for $269. So then in order to calculate the rest of the transaction throughout the 3 years that we have this lease, you'll see in column A, we know we have straight line rent expense of $103 because because we know our lease payments are 103 and 106, so that's a total of 309. And you take the 309 in column B, basically, our future stream of payments divided by 3, and that's 103 per year. So that's our straight line rent expense. Columns B, C, and D are right off of that amortization schedule that I pointed out before. We know our payments are 100, 103, 106 per year in column B. Column C is the interest expense off of that amortization table. And column D is the principal amount off of that amortization table. So the very last column of that table is how much we amortize the asset for per year. That's actually a plug. It's the rent expense, straight line, column A, minus the interest expense that we calculated. That's 19. So we're amortizing that asset $84 in year 1, $89 in year 2, and $96 in year 3. So the asset is amortized. We start slow and speed up the asset amortization as we get toward the end of the asset's life. So you'll see in the bottom right of that slide, the actual entry to record the lease payment and the expense. So we're going to debit lease expense for $103, a straight line lease expense. We're going to debit the lease liability for $81, which is the principal portion of that payment. We're going to credit cash for $100, which is our actual cash outflow. And then we're going to credit the accumulated amortization for $84, which is that plug amount. So that's where I'm like, it gets a little odd. It's not, you know, we try not to do too many plugs in accounting, but basically what you're trying to get to is what's in column A, which is the straight line lease expense hitting the income statement. So now let's do a financing lease. This is basically exactly how you would have done a capital lease in the past. So the initial recognition entry is exactly the same. We have a right of use asset of 269 and a lease liability of 269. That's in that bottom left corner. So the asset amortization is the actual asset, the 269 straight line expense. So, you know, straight line amortization expense. So in column A, we have $90 in year one, $90 in year two, and $89 in year three to amortize that asset straight line. B, C, and D are exactly the same as what they were on that operating lease slide. So those are identical. This is, you know, the expense in this case, though, is what varies. Instead of the amortization varying on the asset, the expense is going to vary here. So A plus C, so your amortization plus your interest expense, is what's going to be impacting the income statement on an annual basis. And then we have the year one entry to record the lease payment and expense on the bottom right of that slide. So we're going to debit interest expense for $19. We're going to debit amortization expense for $90. We're going to debit the lease liability for $81. We're going to credit cash for $100 and credit accumulated amortization for $90. Okay, so the next slide goes through the comparison of those two scenarios, so you can see the difference between an operating lease and a financing lease for the identical asset. Now, when we say it's a financing lease, what we would have to assume in that case is, let's say there was no alternative use for that asset. So now we've concluded there's no alternative use, so we're going to record it as a financing lease. But just generally speaking, this is how the differences impact your financial statements. So on our balance sheet, when we first record it, it's identical, $269 of assets and liabilities. On the income statement, now this is just for year one, we have lease expense of $103 under the operating lease scenario. Under financing lease, we have $90 of amortization and $19 of interest expense. So our income before tax is more impacted by the financing lease early in the lease. It's straight lined basically for an operating lease, the same every year. Financing lease, we're going to be more impacted in the beginning and less impacted at the end of the lease or toward the end of the lease. On the statement of cash flows for operating activities, we have $100 because it's our cash outflow. And for a financing lease, we have $19 of that interest expense in the operating activities and $81 in our financing activities. On the balance sheet, at the end of the year, our lease liability is the same. The lease liability is always going to remain the same, whether it's a financing lease or an operating lease. It will be written off at the same rate. But our right of use asset, our operating lease, is going to have a higher value, $186, than the financing lease, which is $180. So as far as transitioning, Chrissy mentioned that you use the modified retrospective approach. And what you do is basically you have to go back to the earliest date that you're presenting. So if in 2022, I'm doing a single year statement, I just have to start as of 1/1/2022. If I'm preparing comparative statements, I have to restate any prior years as well. So if I'm doing a 2-year comparative statement, you have to go back to 1/1/2021 and figure out what the present value of all of our future lease payments are and present value them back to the date of, the beginning balance sheet of any periods that I'm presenting. So there's a practical expedient that you can, if there, say I'm doing 2 years and 2021 is the first year I'm presenting. If there was a lease that concluded during 2021, there's a practical expedient that said I don't have to figure out those lease payments because that lease is basically gone as of the date I'm implementing. So, you know, that's a helpful practical expedient there. But you do basically take any lease that's a capital lease and that becomes a financing lease, an operating lease becomes an operating lease. And then in order to calculate the liability, as we've said, your present value, the future remaining payments using whatever discount rate that you think is a practical borrowing rate as of the date of the initial application. And then the asset is that liability plus or minus any previous balance sheet items. So if you have deferred rent on your balance sheet from other assets in order to straight line them, you're supposed to have a deferred rent. That would be netted against the asset. And then the expense, you're just going to continue to straight line the recognition based on the new measurement of the total expense.
So like we said earlier, there's going to be an increase in disclosures and footnotes related to these leases. So this is just a summary of the increased disclosures, but don't worry, I'm sure your CPA will be on top of this when they're preparing your year-end financial statement, and we'll have all of this worked in. So everything we just talked about relates to your generally accepted accounting principle prepared financial statement. But there's a lot of other things that you prepare, like tax returns, personal property tax returns, that remain unaffected by this. So we mentioned some pretty large changes to like your fixed asset schedule. So for example, you will no longer have that excavator on your fixed asset schedule. You have this intangible liability. But how does that impact your Maryland personal property tax? You know, these are questions that we're still sort of sorting out. How does it affect your state apportionment factors if you file multi-state tax returns? Are there any other state forms that this could impact? So these are all things that we need to, factor in and assess when we're making this transition. Additionally, none of this accounting affects your taxable income. So all of the effort that you're putting into making sure all of your operating leases are correctly on your balance sheet needs to be undone when you go to file your tax return. Luckily for the operating leases, there might not be a huge income statement change, but definitely something that we'll need to assess, when you're preparing your tax return. And then finally, for your bank covenants, again, we made some pretty large changes. We are now putting a lot of liabilities maybe on your balance sheet that were not there previously, and we're moving items from fixed assets to intangible assets. So if you have a debt to equity covenant, that could be significantly impacted by this change. Also, if you have a tangible net worth covenant, that could be impacted, especially if you lease a lot of fixed assets. Frequently in that calculation, you pull out your intangible assets. And if you're moving all of your fixed assets to intangible assets, you've just had a significant decrease in your tangible net worth. So we definitely recommend talking to your banker about if you have these covenants. Some of the things we've heard is that they might do what's called like a frozen gap so that this change does not affect how you calculate your bank covenants. Or you can have these, for your tangible net worth, maybe have it specifically pulled out that or spelled out that, right to use assets do not factor into that calculation. So, but again, we recommend sort of looking at these now and getting a jump on this because you don't want to wait until you've blown your covenants, in April of 2023, and you need a waiver to talk to your banker about how this standard, impacted your balance sheet and your covenants. So just to recap, a lot of changes are coming in 2022 to your financial statement presentation. And the earlier, the jump and earlier you can get started on this, the better. There's also going to be leasing software. If you have a lot of leases that you can put in, it'll give you your monthly journal entries. I know if you work with like enterprise fleet management, they are on top of this. I recently got some reports from a client and it had sort of everything we needed to record this as of, the balance sheet date, and it had pretty much everything we needed. So you're definitely talk to your leasing vendors and make sure that they're going to be able to provide you with the information that you need for this. Okay, so Sarah, do we have any audience questions? I actually have a couple for Claudia, but let's see what.
Sure, just sorry, let me, did get some private ones. Just got to get back to them. Okay. And again, if anyone has questions, please feel free to privately message me or put them in the chat box for everyone to see, or please feel free to unmute yourself. So the first one that came through was, how do you determine the useful life of a truck? Can it vary truck to truck?
So yeah, so one of the tests that we have is it substantially, the life of the asset. And the life of a truck can vary, significantly from, 5 years to 12 years. So I think one thing to look at is how long you normally depreciate your trucks, right? Because that should also be on your useful life. And then, yes, you can change, so if you have like a truck that visits job sites and gets a lot of miles, this is a truck we know that's going to drive 20,000 miles a year, versus this is a truck that drives on the road and, our marketing person uses it to go to events and it's probably going to have 7,000 miles on it. That job site truck can definitely have a shorter life than your, marketing person's truck. So that can vary lease to lease.
I guess the other thing we were talking about is, say you have a truck that is just strictly on, excavation sites and is getting, beat up with dirt and all that kind of stuff. Maybe it has a shorter life than, a truck that has better conditions, in which it's operating. So just, it can vary just depending on what you expect the usage to be.
Excellent. The second question I have, can you reassess your leases at the January 1st, 2022? Can a capital lease come over as an operating lease?
That's a great question. I do not think that you can, but Claudia?
Yeah, that's correct. That basically, if you have anything that's an operating lease comes over as an operating lease, and anything that's a capital lease would become a financing lease at that date. You might, but in the future, you might be able to reassess things because, we had those bright lines of 90% of the present value of the payments and 75% of the useful life. So maybe you had assessed all of your, Christy was talking about enterprise, fleet management. We see them a lot, and sometimes they're assessed as capital leases and sometimes they're assessed as operating. And maybe you made, an assessment in a prior year, and everything that's enterprise you just record as capital. Maybe you're changing that now and you're recording it as operating. So for the future you can change, but for the past.
Is there any materiality exclusions? This is from David.
Materiality, maybe?
Yeah, that's it.
Accountants
need some more coffee.
I think materiality always comes into play. So if you have, a copier lease for, $200 a month, and it's clearly immaterial to your financial statements as a whole, I think that you could pass on that. Claudia, would you agree?
I agree. Yeah, it's just, I guess materiality almost always comes into play unless you're dealing with certain aspects of the government. Usually in GAAP, materiality always comes into play. So I'd say the same thing here.
Mm-hmm. But you would still need to, I guess, go through some of the calculations to determine, that it's immaterial.
Right.
So,
Right. And then, you know, we always have to look at the qualitative materiality and the quantitative materiality, and maybe it's immaterial from a quantitative perspective, but you know, if you're going to fail covenants, if you actually recorded it, that's always an issue. You know, there's other things to look at.
That's where it gets complicated, I see. Another question. This person, they have a couple of operating equipment leases, but it's just a monthly payment with no distinction between principal and interest. Do they have to use an inputted interest rates?
yes. And that would just be if they were to go out and, you know, finance that piece of equipment, what interest rate that they, you know, they would use for that. A lot of times if there's like, you have no idea, we say start with your line of credit interest rates, because that is clearly stated. So but you have to, yeah, the step one is to make that amortization schedule. And so you need an interest rate for that.
I have one more. How do you record an asset for a short-term rental party lease?
So if it's under 12 months, then nothing needs to be recorded. I guess expanding on that, Claudia, what if you have like it's month to month on the onset, but you end up leasing it for 15 months? What happens then?
Are you saying it was 15 months when initially, but now it's less than 12 when we implement? Is that what you're saying?
Oh yeah, so you know, somebody went out and needed to rent an excavator. I don't know why excavator is the only equipment I'm using. But needed to rent an excavator for a job. And so they rented it month to month and they thought this job's gonna be over in 7 months, but it ended up going 15.
Gotcha. Yeah, it's still, if that's still a month-to-month lease, you're not, you know, you're not locked in. So I don't think that's an issue.
Okay.
That's all that came in through the chat this morning. Again, if anybody else has questions, we'll pause for a second. You can unmute yourself, or again, feel free to type something in the chat box directly to me or to the group.
I have a question, Claudia.
Yes.
Does selling the asset count as an alternative use?
Just selling the asset.
I guess
I'm sorry.
maybe that doesn't factor in at all. I was just trying
And
to.
then you would have ownership. If you're selling the asset, then ownership's transferred essentially.
Okay.
So you'd still fall into that. So I guess if the leasing company had no alternative use for it at the end, then.
Okay. And then does deferred rent go away as a concept?
Yes, because that gets netted, right, because it gets netted into the asset basically.
Okay.
Great. Well, this is a complicated matter. I'm sure people will have more questions as they review the slides and the presentation again this morning. But again, if anybody does have questions, feel free to reach out to Kristen and Claudia. There is their contact information, but again, it will be in the follow-up email with this presentation. Please feel free to reach out to them. We do have one more question. We do have a few more minutes. So David is asking, just to be clear, does this apply to our office lease? That's a good question.
Yes, your office space lease, this does apply to it. So you'll have a right of use asset for office space and the lease liability.
Excellent. Anyone else? Because we are ending a little early, but you can get a few half an hour back to your morning, but this is a complicated matter. So we do want to make sure we answer everyone's questions. Okay. With that, I know Rob has a few announcements we want to talk about, but Kristen and Claudia, thank you so much for your time this morning and on this important topic. And turn it over to Rob.
Sarah, thank you. And Claudia, Kristen, thank you so much for the information. I know this has been a long time coming for this to get implemented. So it's great to get everybody caught up on what's going on. I know, like you said, you're still waiting for a lot of decisions and so forth to come down before this does go into effect. So we'll look forward to getting some updates, and hopefully you'll keep us abreast of all the additional changes and that come down the line, and we'll look forward to seeing that information going forward. Thanks to the entire Katz-Abash team for doing this presentation and for being our liaison and our host for the Accounting Resource Group. Just to let everybody know, this Thursday, MCN is returning to live networking. It's 8 years to the month since our very first Direct Connect, and we're returning to the site of our very first Direct Connect, the Boomy Shrine Center in Rosedale, Maryland. It's from 5 o'clock it starts to 7 o'clock, I believe it is. Katz-Abash is going to be one of our sponsors at the event, so hopefully you'll join us. You might have a few more questions. You'll be able to meet some of the Katz-Abash team in person. We're looking forward to a great event. I just have a little teaser to put out for everybody. In the next day or two, we are going to be presenting a brand new program to MCN members. It's going to be a fuel discount program, and unlike other programs that you see where it's discounted off of the retail price, this is going to be a discount based off of wholesale prices. You're going to be able to save a lot of money. So look for an email coming out this week to announce this new program. And don't forget, we've got another accounting resource group next month. We'll look forward to having you then. And until then, I thank you very much for joining us. Sarah, Kristen, thank you. I'll turn it back to you for any closing comments.
Great. Thanks everybody for coming.
Thank you, everyone. Thank you for joining us.
Next month is going to be really great, so look for that invite.
Excellent.
Have a great day, everybody.
Bye. Thanks.
Bye.
Bye-bye.